All right, so what I'm going to do now is we're going to jump to page 183, and we'll come back to the single stock futures a little bit later today. But what we want to cover is determining short-term market direction and creating a game plan for trading it. And this is really, for those of you that just day trade, I think you'll find some interest in this because it's going to help you develop a market bias. For those of you that swing trade or look at anything in terms of like with retirement accounts and stuff like that, this will be very valuable in terms of determining market direction. Now, the data that we're going to be using for this is a couple of months old. I think it's back in March, so even older than that. But what we do, I do this basically once a week, and I review all the data. And so the purpose of this section is one of the biggest questions I get asked a lot, and I'll get calls from hedge funds and fund managers and stuff like that going who followed the newsletters and stuff like that, and they're just like, how do you figure out long-term market direction or intermediate-term market direction? And so that's what this section was really created for. And I used to spend some time at a couple of different hedge funds down in New York kind of going over those data with them. And although it's pretty simple, the concept, when it's all tied together, is pretty powerful. And it's just designed to keep you on the right side of the market and keep you from fighting the trend. So let's just jump right into this. So basically what I do is every day I go through this. It's called a market prep session. And the whole reason for this is to figure out short-term market direction. And this is really, it's just a big part of my daily plan. And the whole idea here is to develop a plan where the market cannot beat you. Because without a plan, you're just going to be heading into the markets like a cowboy. And while gunslinging worked okay in the Wild West, in the stock market, gunslinging is going to get you killed. So without a plan, you don't know what's going to happen when you jump into the water. You're not going to be prepared for the unexpected. And this routine will get you into a mindset where you can start anticipating what the market's going to do. You really have to think of it this way. I mean, the market is just a swamp. There's going to be alligators out there waiting to make a meal of you. And long story short, the prepared trader does not get eaten by alligators. It's the guys who just go in there and just start, buying and selling, what I call the green bar buy, red bar sell syndrome. Those are the guys that get chewed up and spit out on a regular basis every single day. The way to look at daily market prep is probably the least exciting part of trading. But the way to look at it is if you want to be a full-time trader and you want to do this as a job, the daily market prep is what's going to keep you in trading for the long haul. And this should be treated as if it was part of a job. And you should just pretend that you've got a report that you've got to turn in to your boss every single day. It's very easy in trading to get lazy, especially if you've had a good week or a good trading day, and you just go back into gunslinger mode. And the bottom line is that gunslingers do not survive in this business. That's period end. And this is a good way to figure out to know whether or not you're going to be staying disciplined. One of the advantages that I found in doing this website, Trade the Markets, is that I was writing my research every night for years and years, and then I started posting it. And what I found is that there were days when, like, if I had a really good week and I just wanted to go out and play some golf, or go fishing, or hang out with friends, that I had to post my research because I had a website and people were, logged onto the site and they were expecting and they were dependent upon this research. So it was kind of good for me in that, by having the website to do that, I got forced to do it every night. So it's become a habit where, it feels funny if I don't do it. And so you want to kind of get that same kind of feeling with your own kind of daily market routine. What I have found is that if I don't have this information in front of me, and if I've been slacking off, I will sit there in the middle of a trading day and start feeling analysis paralysis. It'll take me longer to get into trades or to get out of trades because I'm not really sure which way the market's going to go. What I find is that when I do this routine, and you can do this routine quickly, like 25, 30 minutes a day, it really ingrains in me what's happening with the markets, and it really gives me a strong sense of what the market's going to be doing over the next week, next couple of days to next couple of weeks. So, how does this routine start for me? For me, this whole routine starts on the weekend. And I generally will do this like on Sunday night, and I can just take a few hours and look over the markets with a very, very detached state of mind. And on Sunday is like the most valuable day to do this because the markets are not open. You can look at things completely objectively, and you can establish key points in the market without the interference of live market action. So it's a nice quiet time to sit there and spend looking at the markets and decide what's happening. And I start off this entire approach with what I call a top-down approach. And I start viewing the markets in the larger time frames, and then I'll start drilling down to the smaller time frames. And for me, this means starting off with the monthly charts, and then working my way down through the weekly charts, then the daily charts, and then the 60-minute charts to get a sense of short-term market direction. Okay, so let's start off with the charts that I look at every day. Now, the charts that I look at are actually a little more colorful than this. We just had to use black and white charts to so that they would print easier on this booklet. But you can see that this is a monthly chart of the S&Ps. Now, the main thing that I'm looking at here are the moving averages and the oscillators, and this is exactly how I set up my charts. And what I'll have is I've got a 13-period exponential moving average here, a 20-period exponential moving average here, and then a 50-period exponential moving average here. Okay, and this is on a monthly chart. And then I got your basic default slow stochastic, 1433 here, and you can see what this has been doing. And then I've got a default MACD 1226.9 right here. All right, what are the key things that stand out here when I first look at this monthly chart? The most important thing for me is looking at see what the MACD is doing. Okay, you can see the MACD crossed over and went into a sell signal here in March 2000. Okay, and it was in a sell signal all the way into April 2003. All right, what did the market do while the MACD was in a monthly MACD sell signal? The market topped and crashed. That little piece of data alone, for everybody out there, I mean, you can guess how many people I talked to that lost like all their money in the crash. Had they just looked at a monthly chart and looked at the MACD here, they could have not only saved themselves a ton of cash, because on something like this, that's a signal that you use to get out of all your mutual funds, to get out of any long positions, and just stay flat. You don't even have to get short. You just stay flat. And that would have saved you a ton of money and a ton of heartache. Now, if you're a more experienced investor, you would know that once the MACD crosses, you basically just start focusing on the short side. Okay? Now, how do you use the relationship between the stochastic and the MACD? To me, the stochastic is not that important, but what the stochastic is important in doing is it gives you a heads up on what the MACD is doing. So you can see that the MACD sold off here and crossed over. Where did the stochastic roll over? The stochastic rolled over here a little bit earlier. So the stochastic is always the heads up. Okay. I want to write this right-handed again. The stochastic is the heads up. Okay? And then the MACD is the confirmation. All right, so that's kind of the whole key to the relationships between those two indicators there. Now, the monthlies, well, let me show you one more thing here too. On the 13 and 20 exponential moving averages, they crossed here, and they're the same thing, and then they crossed back up over here. And these are kind of the same things as the MACD. When the 13 and 20 period exponential moving averages are crossed higher and moving higher, on the monthly charts, you just focus on the long side. And you can see here, they moved higher for about 5.5 years before crossing over into a sell. Then they crossed over into a sell for about 2 years. Then they crossed back over into a buy just recently. And the reason it's important to look at all these on a monthly chart, because it'll give you a macro sense of where the pressures are in the market. And if the pressures on the monthly chart are higher, there's no reason to fight it. Sure, you can still do shorts on an intraday basis, but if you're bearish on the market, you're going to save yourself a lot of pain and suffering is if you just be patient and wait for the monthly MACDs to cross over, because once that happens, you're going to have, look at this, you're going to have plenty of time to take advantage of moves on the short side. So people who are building up massive short positions here, just because they thought prices were too high, got killed. People who waited for confirmation in the monthly MACD got in at good prices and were able to ride the storm down, or actually just get out of longs. So basically how I start off is with a monthly chart and looking at the macro picture. Remember, when we were talking the other day about the different time frames, the monthly chart, that's the big daddy. That's the 1,000-pound barbell. And then when you go down to the weekly chart, that's the 600-pound barbell. And then the daily chart's the 200-pound barbell. And the 60-minute chart's the 50-pound dumbbell, give or take. You want to know what are the big weights doing? Where is the big pressure coming from in the market? The big pressure is coming on the monthly charts, so you got to know what the monthly charts are doing. Even if all you do is just intraday trade, by just knowing that from March 2000 to March 2003 that the pressure on the monthly chart was down, guess what? You're going to focus more of your intraday trades on the short side, and you're going to be on the path of least resistance more often than not. So it's just something that you want to keep in mind. So I start off looking at the monthly moving averages and the monthly oscillators. On my EMA, do I use an offset? Sarah, if I understand your question, it's just your normal basic 13 period and 20 period and 50 period exponential moving average. All right, so let's go to the next chart now. So what I'm going to do is, first I'm going to go through all these on monthly charts, okay? So now I'm going to look at the key Fibonacci levels. So on this particular chart, I'm just going to sit there and do the Fibonacci's from the key highs to the key lows. And you can see on here where we are. And in fact, this rally up to the 50% retracement level here in early 2004 ended up being the dead highs of this move. And as of today, as we're doing this on August 15th, the markets are actually closer down, back down to this 38% retracement level now. So we're at the next key fib. And look at this, the next key fib to look at is down here at 970. So it's just important to know where these key levels are on the S&P on the monthly charts. All right. Oh, Scott, let me back up here. Yeah, the main thing is that first I'm looking at the 13 and 20 and how they're behaving. On the 50, though, the 50 is more of, it's kind of a bigger picture thing, too, because what will happen is that when the 13 and 20 EMAs cross to the downside, that's kind of a heads up. And then when they cross the 50, that's kind of a confirmation. So in case there was ever any wonder. So, like right now, you can see that the 13 and 20 had crossed higher here back in March, and this isn't a current chart. This chart's 4 or 5 months old, so we can look at actually we'll look at some current charts tomorrow. But you just want to see, do these things actually cross through the 50, or do they turn over and get rebuffed? So that's what you're looking at there. It's kind of a confirmation of a trend change. Now, the moving averages are kind of lagging indicators, so what you do is you get heads up on these. When I said that the stochastic was a heads up to the MACD, well, the weekly chart's also a heads up to the monthly, the daily chart's the heads up for the weekly, and so on. All right, so we just looked at the monthly Fibonacci levels, and all these levels are so important because the monthly charts have so much weight on what's going on here. And the reason they have so much weight is if you know, even though a lot of us as individuals can spend time day trading, Well, guess what? The funds that are managing billions of dollars and that really move the markets, they cannot day trade. They've got to take positions based on weekly and monthly charts because those allow them the volume to get in and out of positions on those time frames. So that's the levels that are most important because that's where most of the transactions are taking place. All right, so the next thing I look at then is after I look at the Fibonacci's is I just look at basic channels and trend lines. So you can see here on the monthly chart we had formed, and this is still a current channel, we've got this nice downward channel here. We did have a pretty stiff uptrend, but that's been broken. But even though the markets had a nice hell of a rally here from the March 2000 lows, and everybody on CNBC is talking about the bull market's back and blah 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 blah, in reality we're just stuck in a downward channel. And as of this writing, we peaked up above this channel and we've dipped back down below it. And we're just kind of caught in between this downward channel on the monthly charts. So that's important to know. What will happen is, if you get really excited on a daily chart, just go to a monthly chart. Take a look and see what's really going on, because that's going to give you a much clearer picture of what's going on. All right, so what I'll do then is as I go through the monthly chart, I'll just write down the key, I'll just kind of keep an ongoing notebook of what's going on. Now, obviously, the monthly chart moves pretty slow. So once you do this once, all it takes is a few minutes a week just to update your analysis of the monthly charts. So you can see here, the S&P has rallied into the 50 exponential moving average, which is acting as decent resistance. The 13 EMA is below this level at 1,050, and the 20 is at 971. So I'm just marking some levels there. The stochastics went into a buy on March 2003. And the MACD went into a buy in April 2003. The last signals on these were sells in April, May 2000, so this is very significant. The stochastics appear to be stretched and rolling over. The key Fibonacci level is the 50% level at 1163.80, and that turned out to be almost the dead highs of this move up. So, see, real quick, I'm just going through and just summarizing the key points of the monthly charts. And then I'll just kind of go through and say, all right, now when I look at the trend lines and basic support and resistance, there is key structural resistance at 1175, and that's just basic trend lines. Just noting that the current high used to construct a new downward channel, and that channel is now the active channel unless we get any closes above that. And then a note on the oscillators that they're overbought, and just that overbought and oversold is not so important. The main thing with the oscillators is that you just want to look where they're pointing. Are they headed higher or are they headed lower? So what I'm doing is I'm just kind of going through the monthly charts and just kind of making some notes as to what they look at. All right? So now what I'm doing is, that didn't take too long. Now that we look at the monthly charts, then I'll just drill down to the next level and take a look at the weekly charts. And on the weekly charts, again on here, I'm looking at this as a stochastic that went into a sell signal here in March 2004, a little bit earlier than the MACD went into a sell. So again, the stochastic is the heads up, the MACD is the confirmation. And so that's what I'm looking for there. Same thing, I'm looking at the 1320 EMAs, the cross to the downside here, cross back up here, and look like they're trying to cross back lower here. And it's the same thing. I just want to know, is the path of least resistance higher or is it lower? And once you can just do this at a glance. And then once I get that, then I'll just flip on to the next set of key levels. And this is the Fibonacci's. And on the weekly chart, I'm just taking the current high along with the most important low and just looking where the current Fibonacci's are. And you can see that we've got some key levels down here at 1070, which is, we're just under that right now. And then the 38% level is down here at 1021. So these levels right here are really good to know, because if we get down to the 1070 level, which we've breached, then there's not really any key support on the Fibonacci's till 1021. And so that's important to know. And those are figures that I want to write down and keep track of. All right, so once I look at the Fibonacci's, then I'm going to go look at basic trend lines. Let's look at where key resistance is. Look at this. Double top right here, key resistance. That ended up being the top of this move, and I couldn't get through it. Key trend lines here. This weekly has had a nice rally. When is it going to finally break this trend line? Well, when it did break the trend line, it just fell with a vengeance, and we're currently trading about right here. Okay? So these are all levels I just want to be aware of. And the whole idea of this exercise is just to make a trader cognizant and aware of the key levels and the key pressures in the market. So, I'll just go and take out my notebook and jot down my notes on the weekly chart. So I'll note here that the cash index has fallen through the 13 exponential moving average. It's trading near the 20. And I'll note that if we get a close below the 20, I'm going to look for a move to the 50 EMA at 1032.51. The stochastics and the MACD have both recently crossed into sells. And then the first key Fibonacci level is the 25% retracement level at 1070.63. And what I want to do throughout this exercise is I want to keep writing down and keep noticing these numbers, because what I'm going to do is once I get through these monthly, weekly, daily, and 60-minute charts, I'm going to see if that, does this 1070 level, does this correspond on any other charts? Does this 1032 level, does this correspond on any charts? Because that's how you get some of the confluence that'll mark major turning points in the market. Okay, and then here's just some additional notes, just marking support and resistance, and also where the current uptrend is doing, and then the current monthly downward channel. All right. So then once I get through this, I just move on and go down to the daily charts. And on the daily charts, I just do the same thing. I'll just look at, okay, what's the MACD doing? The MACD went into a sell in March 2004. In January 2004, and as of this date, it was still in a sell. The 1320 EMA crossed higher and just started crossing lower up here. And it's just kind of the same thing. I'll note here that 1060 on this particular day was the 50-period moving average of the S&P cash index. And what will happen is when indexes fall through one series of moving averages, they'll start drifting to the next moving average. So which is why you always want to be aware of where these moving averages are sitting. Same thing. Then I'll go to the daily chart and do the Fibonacci's. Where are the key levels on the Fibonacci's? And then once I get those, I'm going to go look at your basic trend lines and basic support levels on the daily chart. And I'm going to start noting and writing down those key numbers just to see where everything is sitting. Here's a nice upward trend line. I want to know, have we violated that? Are we still in that? Here's a key support level. I want to know, where are we in relation to that? Okay. So once I get all that stuff, then I'm just going to go through and do the same thing on the daily charts. And I'm just going to make a few notes, a few index cards, and note, okay, what are the exponential moving averages doing? Where are some of the key moving averages? What are the stochastics and MACD doing? Where are the key resistance levels? On the Fibonacci levels, what's happening there? Where is the key levels? Here's another thing I like to do is here's a key level on a daily chart, 1097.76. Here's another key level, 1077.34. Here's another level, 1075. And I'm just going to keep jotting down all these different levels. All right. So now, look at this. It's only taken like 15 minutes, and I've gone through the monthly charts, I've gone through the weekly charts, and I've gone through the daily charts, and I've made notes on each, and I'm starting to develop a bias for the markets. And now what I like to do, especially because the 60-minute charts will give me a really good feel for the next trading day. And you can see here on this particular chart, on the 60-minute charts, pretty much everything is rolled over to the downside on the moving averages. But it's trying to maintain itself. The stochastic is trying to turn higher. Remember, the stochastic is a heads up, and the MACD is trying to turn higher. So I can see here on the 60-minute chart that the markets look like they might be trying to pop a little bit. And then on the 60-minute Fibonacci's, we've sold off here from 1161 on this chart down to 1103. So I want to know where is the key retracement levels? Well, look here. 1118 is a key level on the 60-minute chart. And then if it can get through that, then this is the next key level on that. So I want to know where those key levels are on the 60-minute chart. And then I just go again through the whole same thing. Now let's look at the current trend lines. You can see on the 60-minute chart we've got a nice downward trend. So I'm going to be aware of, if this 60-minute chart can break through this trend, then we've got potential rally potential here up to 1131, which is this resistance level. All right, so now that's done, and I do the same thing. Let's just write down a few notes on the 60-minute charts. Where are the key moving averages? At what price points are they? What are the stochastics and the MACD doing? On this particular chart, they had slight bullish divergences. The 200 moving averages acting as significant resistance on the 60-minute chart. I want to point out where the key fibs are. I got a key number right there at 1133. Key resistance there at 1134. Okay, so now basically in about 20 minutes we've ran through, and and you can do this on different markets. You can do this on the Dow, the Nasdaq, and the Russell. I found that by just doing it on the S&P, it's still going to give you an overall bias for market direction, which is really what the whole point of this exercise is to give you a bias for the next couple of days to the next couple of weeks. So now that we've gone through all 4 time frames on the S&Ps, what I like to do is then start consolidating the information and giving myself a trading plan for the next trading day. So what I'm doing is I'm looking for themes that stand out across all 4 time frames. What are the key numbers that stood out? So what I noticed when I did this exercise, that this level, 1060 to 1075, offered a lot of support on different time frames. There was that on the monthly chart, on the weekly chart, on the daily chart. Those numbers stood out. Whether it was Fibonacci levels, simple support and resistance, key moving averages, that level seemed to stand out very, very well. And it's important to realize that level because, first of all, if there is a lot of confluence at an area below the market like that, the chances are very, very strong that the market is actually going to come back and test those levels. And when we did these charts in March, and now we're here back in, we're in August, and that's exactly what the market has done. It's basically rolled over and come down and tested those key levels. Basically, the S&Ps have fallen like 100 points since we've done this analysis. So on the week, there's weekly support here at 1060. Key levels here. The markets here, 1130 to 1140, offered a lot of resistance. And so you can just see by going through these different time frames, you can just find areas of confluence and areas that basically everybody's going to be attracting prices towards. So here's the things that I'm looking at. What I like to do is, by doing this top-down approach, is look for 2 main things. The first thing I'm looking for is I'm trying to figure out what are the key pressures on the market today. And by key pressures, I mean, what is the pressure on the monthly chart? Are the stochastics rolling higher or are they rolling lower? Is the MACD rolling higher or is it rolling lower? Because that's very, very significant. If the MACDs are rolling lower and the stochastics are rolling lower on a monthly chart, that means that the overall, the heaviest pressure on the markets is down. And you don't want to fight the monthly charts. And what will happen then is that starts to give you a bias, that when every time you see rallies, you look at rallies as an opportunity not to load the boat, but as an opportunity to sell longs and get short, because the biggest pressures on the market are to the downside. And you just kind of go down like that. And as you can imagine, what this is leading to is that you'll know that 2 or 3 times a year you're going to have really, really big moves. And when do those moves happen? They happen when the monthly charts and the weekly charts and the daily charts all align together. So when you have the weekly charts pointing higher and the monthly charts pointing higher and then the daily charts point higher, all 3 in unison, that's when you get the biggest moves to the upside. And then also on the downside, when you have the monthly charts roll over and then the weekly charts roll over, and then the daily charts roll over. That's when you get the biggest moves to the downside. Now, most of the time, these charts, you'll have the monthly chart could be pointed higher, the weekly chart pointed lower, and that's fine. You're just going to get markets that are trading in more of a tight range during those time frames. And it's important for you to know when those times are so that you can get more conservative in your targets. But on those times when all those time frames line up together, that's when you're going to get the really big moves in the market, and that's when you want to make your bigger bets on a swing basis. Okay? So what I do then is once I get all this information, I just like to put them together in a little box like this. So I can just sit here and go, all right, on the 13, 20, and 20 exponential moving averages, I can sit there and go, okay, on the monthly it's higher, on the weekly it's higher, on the daily it's lower, and on the 60-minute it's lower. So by looking at this, I can sit there and go, all right, this is great. Now, when the daily chart starts to roll to the upside, I definitely want to take advantage of that long because that's moving in conjunction with the weekly and the monthly charts, right? And same thing with the 60-minute chart. And let's go through and do this on the oscillators. When we did this back in March, you had the stochastic and MACD on the monthly charts higher, but on the weeklies it started to roll over. On the dailies it was rolling over, and on the 60-minute it was rolling over and going lower. So on something like this, and what happens, remember, the smaller time frame is the heads up for the larger time frame. So when the 60-minute goes lower, that's a heads up that the daily could start turning lower, which is a heads up that the weekly could start turning lower, which is a heads up that the monthly could start turning lower. So the most powerful signal here would be when the monthlies rolled over and went into a sell, and now you had all four into sells, you're going to get the biggest move down. And that's exactly what happened back in July. The monthly stochastics rolled over into a sell, and now the monthly and the weekly and the daily and the 60-minute were all on the same page, and boom, we got the markets to move down really, really good. Okay? So now and then we just kind of do this in the same, where are the key levels on the Fibonacci and support levels? Well, take a look at this. This was back in March. Key levels for support, 1072, 1060, 1070, 1097. What happened? The markets basically fell 90-some-odd points to exactly these levels, and this is where we're trading today as we talk about this. So this is how you can use these things to kind of predict what's going to happen over the next whether it's a couple of weeks to a couple of months, it's going to give you an idea and a bias of what's going on. Same thing with the key moving averages. I just go through and I just like to write them down, see if there's any confluences. On the monthly, the key moving averages, I can just go through and sit there and go, okay, wow, the 50-period moving average is almost just the same as the 20-period moving average on the daily. Wow, that's going to offer a lot of support at that level. The 13 on the 60 is just about the same as the 20 on the weekly. Wow, that's going to offer a lot of support or resistance there. So I just like to go through and just kind of mark any levels that have confluence there. So what I do with this stuff then is I go through, and again, I do this about once a week. Takes me about 20 to 30 minutes. And once I have this information, I then start formulating a trading plan for the next trading day. And what I'll do is I'll get the basic pressures off the monthly, the weekly, and the daily charts, and then I'll start looking at the key price levels, and then I'll start setting up a trading plan based on this accordingly. And based on this analysis, this is what we did back in March. This was our game plan. We wanted to use any rally to 1135 on the S&Ps for a potential move to 1070. Okay, this is an analysis that we did back in March at a seminar that we did in Los Angeles. And this was back in March, and we were able to kind of predict what the market was going to do over the course of the next 3 to 6 months, and that's exactly where we are today. So it's a pretty powerful way to analyze the market and get an idea of what the market's going to be doing over the next couple of weeks to the next couple of months. And this is something that we're going to look at tomorrow during the day. I'm going to go through and take you through the monthly, the weekly, the daily, and the 60-minute charts live so we can look at them what they are today and get an idea of what we're going to be doing 3 to 6 months from today. Oops. Okay, something just freaked out here. Okay, so let me open this to questions. Do you guys have any questions on that section? Because all that is just to kind of it's just a way it's a way that you can quickly get a bias on the markets on a swing type of approach. Do I have spreadsheets set up? I don't have. Let's see. Basically, what I do is I just kind of keep these in a Word document. I can send the Word document to you, and just remind me. Just anything that you guys, any questions that you guys have, or anything that you need, just send me an email. Oops, I got to retype it in now. Just send me an email, and I can take a look at it. Bradley, that's a great question. What weight do I put? Basically, the larger the time frame, the more weight that I put in it. If you go back and look at that monthly chart, I mean, look at what the markets did when the MACDs finally crossed over into a sell. They just got crushed. And the monthly signals can last for years. These are not precise entry. These are not things that you use for exact entries. These are things that you just want to get a bias, whether the market has upside pressure or downside pressure. You know, if the MACD rolled over like in April 2000 to a sell, so that doesn't mean that you're going to get an exact price entry. You know, if you're trying to short CMGI and you're waiting for the MACD to roll into a sell and you're going to use a $10 stop, that's not going to give you an exact setup for that, but it's going to give you a bias that the market is rolling over and that now it's time to start focusing on the short side as opposed to, buying the dips. Yeah, and so basically what it is like, the monthly is the most important, the weekly is the next most important, and then the daily, then the 60-minute. So in terms of the pressure, but what's going to happen is when you're making it's the reverse for when you're making your daily entries. So what I find is that let's say I'm in a monthly sell, and then a weekly sell, and a daily sell, and then a 60-minute sell. Well, I've got sells across all time frames, but I'll use the 60-minute chart to get my entries because the 60-minute chart is more precise and it's going to focus more on what's happening today, whereas the monthly charts, that's much more of a macro picture. Right? Yeah, and Ron, you can use this approach that I showed you with the S&Ps. You can do this with any market. Bonds, currencies, grains. You can do this with individual stocks. You can just take KLAC, put it on a monthly chart, weekly chart, daily chart, 60-minute chart.
Don't tell me.
So yeah, you can do this on any market. You just take it through those time frames. And actually, one of the things that I like doing, and I'll show you guys tomorrow, is on TradeStation. I just set it up where I type in a symbol like, okay, S&P, and I've got it split up into 4 charts, and it's going to show the monthly, weekly, daily, and 60-minute chart all at the same time. So I just type in a symbol, boom, I can do this analysis instantly looking at all 4 time frames. And so I'll have one that shows the moving averages and the oscillators, boom. And then I've got one that's for Fibonacci's, boom, all 4 time frames. Another one for support and resistance, boom, all 4 time frames. So it's kind of a nice way to get a quick check on what's happening on the markets.
That might fix it. Sounds like a Pepsi commercial.
Oh, sure. It's like, all right, so let's go again. If you're just focusing on day trading, I still think that that's pretty valuable information because it's going to give you a bias. And if you are doing some swing trading or trying to move retirement accounts or anything like that, that stuff's priceless. Now let's go ahead and let's move on to the next section, which is the pre-market checklist. All right, so this is kind of like continuation of what we just talked about. Now, what this pre-market checklist is about is really more about what do I do today. All right, I'm trying to formulate a game plan for today. So that's what I want to look at. So there's a certain amount of things that I look at to help give me a bias for what's happening. And so this is what I do. Now, this is something that I include in the newsletters that I write. And what I do here is I'm going to take all that stuff that we just talked about on the monthly charts, the weekly charts, the daily charts, and the 60-minute charts. I'm going to put it together here in a simple, easy-to-use spreadsheet that I can glance at. So look at here. Here's a stochastic. Okay, that was a terrible drawing. All right, let's try that again. Here's the stochastic. All right. And here's the monthly reading, the weekly reading, the daily reading, and the 60-minute reading. So on this particular day, the monthly stochastic was all in buys. On the Dow, the S&P, the OEX, the NASDAQ, the NDX, and the Russell. The weekly was all in buys. The daily was in sells. The 60-minute was in sells. And what I can do with this is at a glance, I can just sit there and I can see the markets turning on different time frames. You know, when the market's like selling off and it's starting to move higher, well, guess what's going to happen? The first thing that's going to happen is the 60-minute chart's going to go into a buy. And then the daily is going to go into a buy. And then the weekly is going to go into a buy, and so on. And so this is a good way, as you watch this, to see how the markets are handling like that. The RSI, it's basically the RSI. What I'm doing with the RSI is that I'm looking for bullish and bearish divergences. And if you guys look at, I've actually changed this around recently to also add the squeezes. And what I'll do is I'll look at a chart and say, okay, do we have on a daily chart, do we've got a short squeeze or a long squeeze? Like on the weekly charts right now, we're in short squeezes on all the weekly charts. And so that's something that I've added to my analysis as well. And so I can just sit there and go, okay, on the daily chart, we've got a bullish RSI divergence. On the weekly chart, we've got a short squeeze, and so on. And so that's stuff that I've added to this. Okay, and then in addition to those key indexes, I also like to look at some key sectors. I like to look at the banks, the brokers, the semis, hardware, and then retail. And there's other sectors you can look at. I just like to always look at those. And then I like to look at key stocks. IBM, General Electric, and Merrill Lynch are three key stocks that I like to see. You know, are these stocks rolling over, or are they being bought, and so on and so on. And so what can happen is that by just staying on top of this and filling this out every week, I get a very good feel of what the markets are doing or about to do based on all these different time frames. And I find that it's a very handy tool in determining, you know, which way to focus on in terms of swing trading and also drilling down to intraday trading. Also, the other thing I like to do is I will just sit there and I'll look at what the volume was for that particular day. And again, this is all stuff that I put in my newsletter too. Well, I'll just sit there and I'll just look at, okay, you know, what was the up-down volume on the NYSE, the down volume? How did this compare to the day before, percentage-wise? And most importantly, how did the total volume yesterday compare to the total volume today? What was that percentage move? And what was the total volume? You've got the 50-period moving average. How does the 50-day average volume compare to today's volume, and what is that percent? And that's really important, because if you've got a big move without an increase in volume on the exchanges, you've got a move that's not long for this world. You've got to see volume coming up in these moves. All right. Now, here's some other key levels that I look at before each trading day. All right. One of the things that you can look at on the S&Ps to determine whether or not we're in a trend or if we're just in a consolidation period, is to look at the prior 3 days high and the prior 3 days low. And so what you do on this is like, okay, here's today, right? Let's just call this Friday. So if that's Friday's range, what you want to look at is the prior 3 days of trading. And then you just take the prior 3 days high, which in this case was right here, and then the prior 3 days low, which in this case was right here, and you just want to see, did today's trading exceed and close above or below either one of those levels today? Well, you can see here's today's high, here's today's low, and you can see that it did not exceed those levels. So what does that mean? That means that the market is stuck in a trading range, and not to expect any big moves out of the market until it can break the prior 3 day high or the prior 3 day low. So that's something I like to keep track of. Because basically, if the market cannot break the prior 3 day highs or prior 3 day low, and it's stuck in a trading range, well, guess what? I'm going to make my targets. I'm going to be more aggressive with my targets. I'm not going to give the markets that much room. I'm not expecting the markets to run 20 S&P points or 200 Dow points because we're stuck in a trading range. The other thing I like to look at, and this is something that Hubert's going to talk about here in a second, is I like to look at the low of the high week and the low of the high month. Okay? Those are very key price levels, and we had some hedge funds that we worked with teach us about this strategy, and this is something that Hubert will go over here shortly. And I also like to know what the prior week highs and lows are, because those are some key price levels. And then you guys remember when we yesterday when we started talking about gaps, and I talked about how open gaps kind of act as a magnet for any price action? Well, guess what? I want to keep track of all open gaps. If there's an open gap sitting out there, I want to know about it, and I want to have that in front of my trading screen for that particular day. The other thing I'm going to do is just basically have all the pivots in front of me. The pivots is something that we've gone through, and you guys know how to do that. This is the Excel spreadsheet that I use, and if you guys, I'll be sending that out to you guys when this is over. So I just like to know where the pivots are, and that's includes the weekly and the monthly pivots as well. The other thing I like to look at and to stay on top of are just some kind of key sentiment readings. So what I like to do is I like to look at, we were talking about the put-call ratio. I like to know where that closes. And remember, what I'm looking for here, did it close over 1 or did it close below 0.50? Most of the time it's neutral, so I want to know when this thing is going to be an extreme reading or not. Then I like to look at the 10-day moving average of the put-call ratio and see where that is. Also the 10-day moving average of the OEX put-call ratio. And then I like to look at the investors' intelligence numbers and the AAI investor sentiment numbers. How many people there are bullish and how many people there are bearish. And the idea with this is that if there's too many bulls, the market's running out of buyers and to expect a top soon. And conversely, if there's too many bears, the markets are running out of sellers and to expect a bottom soon. So that's what I'm looking for there. And you can see, and one good site for all this information, and it's like $30 a month, is called Decision Point. And this is where I'll get this information. And take a look at this. This is the 10-day moving average of the put-call ratio. Look at this. Anytime it gets under 1, okay, here's the 10-day moving average under 1, market bottom. 10-day moving average under 1, market bottom. 10-day moving average over 1, market bottom. So anytime I see that, even though this does not happen very often, anytime that the 10-day moving average gets above 1, I want to know about it because that generally coincides with a market bottom. with that sentiment stuff on the bull bear, how many bulls and how many bears, take a look at this. When you get too many bulls, like here's an extreme bullish reading, and where does that happen in the market? Right before a top. Boom. That's when we get the big sell-off. And just recently, when we were doing this, we got excessive bullishness again right around 1160, which was right where the top was on this current market move, and that happened back in March, or right near the beginning of the year. Same thing if you got too many bears. Look at this down here. Way too many bears in March 2003. Boom, we put in a bottom. So that's why I like to look at that and just kind of get a glance and see where we are. These don't generate a lot of signals, but what you're looking for are extremes, because when you get extreme readings, that generally signifies a market turn. The other thing I like to look at is the NYSE member net buy-sell numbers. And this just shows how much inventory the specialists have. And again, this is just a chart that you can get on Decision Point. You can see here that the specialists were long net 500 million shares of stock. Well, these guys know what they're doing. Anytime they're getting long stock, it's because they want to go ahead and sell it to you at a higher price later. So they loaded up down here, and then you can see where all the selling took place. Basically, they just started selling right up here. So they loaded up the boat and then distributed inventory. And then here they loaded up the boat again, right about here. And as the market rallied, they distributed inventory. So it basically just kind of shows you what the big boys are doing and helps you keep on the same side as to what they're doing. The other thing I look at, I was talking to you guys yesterday about gaps and about the pre-market volume and what we're looking at. The stocks that I look at, you can just go over to onechicago.com, all right, and that's the website, One Chicago, and it's going to show you all the stocks that they have single stock futures on. And so then that's what I'll do, is I'll just look at all these, and I don't look at the single stock future, so you can just cross those out. What I do is I take the actual cash stock, and that's what I look at for the pre-market volume. I want to see what Amazon's trading, American Express is trading, Applied Materials is trading, Broadcom is trading, and I just want to see what those are doing before the bell opens. And then just some miscellaneous key points of stuff that I look for. I want to know, what key earnings reports do we have coming out the next day? Is it going to be what I call a big daddy? And a big daddy is somebody like IBM or Microsoft, Cisco, Yahoo. These are companies whose earnings everybody's following, and they can affect the market. The other main things that I like to look on here is that, are we going to have any, what are the high tick readings and what are the low tick readings? That's pretty important, because if you get a high tick reading of, say, 1,083, and then the next day you're able to break that level, that's important in terms of bringing new buyers into the market. And that's the main things that I'm looking for there. And now, so basically the rest of the stuff is just basically some things that we've already reviewed. I like to look at those key sectors, the banks, the brokers, the semis, retail, just to see what they're doing. The markets are not going to be able to have a sustained move without the banks, the brokers, and the semis. So I always look at these sectors are really good because they're kind of early warning signals for the rest of the market. So I do pay a lot of attention to those three sectors. And then also just kind of looking at the monthly, weekly, and daily pivot levels and see if those correspond with any of those key numbers from our top-down approach. Oops. And, okay, I got one slide left here. Yeah. And then the other things I look at, and this is something that's hard to measure, and it's pretty subtle, but it's very important. And I just ask myself, how are the markets reacting to news? When bad news comes out, are the markets falling apart, or are they rallying? When good news comes out, is the market falling apart or is it rallying? That can really tell you more about the current state of the market than anything else. Right now it's basically the market selling off on bad news and good news. It's a sign that the market's in deep trouble. I also like to know, what are people away from Wall Street doing? Like whenever I get a call from my mom going, gosh, John, I was just looking at eBay and it looks like I think I'm going to buy some for myself. I'm a seller. I'll go out there and short it. And I'll tell her and I'll say, look, Mom, I thank you for telling me that tip. If I were you, I would just hold off and wait, because it looks like the market may sell off. And that generally saves her a lot of money and makes me a lot of money. And so that's a good kind of a litmus test of what's going on. So now, basically, these two sections that I just went through that's what I do and what I look for to get a bias on the stock markets for the intermediate to long term. So, yeah, I kind of tell my mom that I'm kind of using her as a gauge like that, but I don't want to tell her too much because then she'll get nervous about it. But I do try to save her money by telling her that just to hold off and wait.
So when do you sleep?
Well, it's kind of this process that I just took you guys through. It seems like a lot, but really this is something that it takes me about 30 minutes a day after the market closes, because you just go through and you can knock it out really fast. And if you guys like the news and don't want to follow it, I put it in my newsletter every night, and so you guys can even just look at that. But what I basically do is it takes me 30 to 45 minutes a day, and then on the weekends I spend about 2 hours. So it really doesn't take that long, and it just kind of keeps me on top of what's happening in the markets. Yeah, our poor moms, exactly. So now I've just kind of flown through it. Now, what I found is that this part of the seminar that we just went through is probably going to be the most data that you're going to get, and it's probably, in terms of data overload, this is probably the biggest part of data overload. So what I'm going to do tomorrow is on Monday is what we'll do is before the market opens, we're going to get into the room early, and we're going to start going through the monthly charts, the weekly charts, and the daily charts, and all these other things, and we'll get a bias on the markets before the market even opens. Okay, so that's what we're going to do tomorrow. So now when I'm doing that, you guys will understand what I'm doing. All right. So if you guys have any questions on this, fire away. Otherwise, let's take about a 10-minute break, and we'll get queued up for the next section and get going. All right, I'm going to go ahead and cut this off, and then if you guys have questions, we'll answer that when we get back. So right now it's 5 after 3. We're going to get started again at 3:15.